Welcome to In the Harbor, the podcast where sports, leisure, and finance meet. I'm your host, Jason Johns, and today we're diving into a conversation that's right in the wheelhouse for advisors thinking critically about ETFs, sector strategy, and how to build smarter portfolios. Today, I am joined as my co-host, Rock Harbor's very own head of research, Mackey Daniel. Welcome in, Mackey.
Thank you, Jason. Happy to be here. Great to finally be on the pod. We're excited because we've seen a real shift in how advisors are using ETFs this year, whether it's factor tilts, being more precise with their sector exposures, and the more active use of those exposures, and even active ETFs, which we've seen a huge rise in this year. And today's guest is someone who's been at the center of that evolution for years now.
Absolutely. Joining us is Paul Baiocchi, Chief ETF Strategist at SS&C ALPS Advisors. Paul's worn a lot of hats throughout his career. He's built ETF platforms at Fidelity, shaped the conversation at ETF.com, and now helps drive the strategy behind the ALPS and Sector SPDR lineups. He brings 2 decades of experience working with advisors, building product strategy, and helping investors make sense of a crowded ETF market.
He's also a huge San Francisco sports fan, big Bay Area sports guy. So we may sneak in a Giants or a Niners question, maybe nothing about the 2024 NFC Championship game where the Niners, unfortunately, took down our Lions. But, the real reason we're here to talk today is about market leadership, factor opportunities, and how Paul thinks advisors can position for the remainder of the year.
Excellent. I'm looking forward to the conversation. This is In the Harbor. We're glad you're here. Paul, good afternoon. Thank you for being here with us today.
Great to be here. Good to see you guys.
Absolutely. I think just kicking it off, why don't you give us a little background on you? You've had quite the career from ETF.com to Fidelity to ALPS. What kind of led you to the industry, and how did you get into it on the ETF side specifically?
Yeah, it's not going to be as compelling as some Marvel Universe origin story, but my origin story in finance is kind of interesting. My grandfather, who immigrated to the United States from Italy right around World War II, fought in World War II, got dropped out of a plane, survived that, which I'm very thankful for, as you can imagine. Otherwise, I wouldn't exist. And he, as many of the immigrants during that period of time to the United States, was able to work hard, save money, own his own tavern, and he socked away money. And he sort of taught himself about the stock market and started buying stocks with his excess savings, and, never had any debt in his life, paid for his only house that he lived in for the rest of his life with cash. And when I was younger, they lived in Chicago. I was in California. They would come and visit us, or we would go and visit them. And I remember distinctly in middle school, he brought out one of those old S&P stock guides or stock books. For those of you who remember, it was a printed booklet that showed the stock prices for all of the stocks in the S&P universe. And he basically told me to read it, to learn it, to understand it. And the next time we were going to talk, he was going to ask me about it. And because I was in middle school, I probably didn't do it to the degree that he was expecting, but it got me familiar with stocks at a pretty early age. And my mom's brother, my Uncle Paul, great name, by the way, he was in the financial services industry. He worked in investment banking. He was a broker, and I've always been very close to him. And so he and I would catch up when he came to California, which was rare. When we went to Chicago every year for Christmas, I looked up to him. And when I went to undergrad at CSU Chico, shout out to the Wildcats, I knew that I wanted to study finance. It was something I was interested in, and not for nothing, I knew it was a place where you could make a pretty compelling career. And so I studied finance through undergrad. I came out of school, got a job at a small broker dealer in Southern California as a Series 7 broker, where we were buying individual stocks on foreign exchanges for investors who, at the time, believe it or not, couldn't go to Schwab or Fidelity or any of those shops to go and buy stocks directly on foreign exchanges. They either had to buy OTC, or if there was an ADR, they could buy it in the United States. And so we had a little bit of a niche in that regard. And that sort of kicked off my career. I was buying individual stocks for individual investors. And it was your typical brokerage model where we were earning commissions on either side of those trades. But over the course of a couple of years, I sort of realized that I didn't necessarily have the composition to be in charge of people's money. I would go to bed at night wondering if we made the right purchase. And so I decided that I wanted to expand my toolkit and perhaps get into a more strategic role. And so I decided to go back to school, went to the University of British Columbia to get my MBA. And while I was in grad school, I had a former colleague who started an RIA, and they were doing sub-advisory work for a firm that some folks might remember, Claymore. And we were building indexes for UITs at the time for Claymore. And I was helping consult to them, helping to build some of these thematic indexes. So think global coal at the time, or Canadian royalty trusts, which were a thing once upon a time. And then they came to us, Claymore that is, and asked if we could build an index for an ETF. And it was really my first introduction to ETFs. This was 2008. And what's interesting about it is I got really enamored with the ETF wrapper. The other piece of it is that we were launching a global shipping ETF at a time when the world's economy was coming to a standstill, and you couldn't even get a letter of credit to ensure the bulk that you were shipping from one part of the world to the other. So from a timing perspective, the product could not have been more poorly timed. But in timing for my career, it could not have been more fortuitous, because if you look at a chart of ETF assets and ETF adoption, it is really out of the GFC when you start to see exit velocity in terms of ETF asset growth, issuing growth, and of course, the investment. And there's a number of reasons for that, but ultimately that Claymore business went away. They got acquired by Guggenheim. And so they ended a lot of those sub-advisory relationships, including the one they had with our firm. And so I was out looking for a job during the teeth of the financial crisis. And luckily on Craigslist, believe it or not, there was a firm in San Francisco at the time called Index Universe that was trying to hire a team of analysts to build an ETF classification system, as well as an ETF's analytics platform, which was designed, or they were trying to, or attempting to go to bat against Morningstar, to be the Morningstar of ETFs, if you will. And so I jumped at the opportunity. Luckily, they hired me. And over the course of the next, let's call it 4 years or so while there, the firm evolved from Index Universe to what most people know now as ETF.com. We built a classification system. So think about a taxonomy of ETFs, where they live, what segments of the market they compete in, and then an analytics platform that lived online in the cloud that was designed to be a portal for advisors to be able to pick and choose among ETFs. We wrote analysis, so it wasn't all quantitative. We would write about those ETFs. We would do segment reports where we were writing about all of the ETFs in the segment. We had at the time the largest ETF conference in the world, Inside ETFs, that we were the provider of. So I was going to those conferences, I was moderating panels. I was just getting and building a network in the ETF world that proved invaluable. And so right around 2014, Fidelity decided that they were going to try and make a real run at ETFs and to try and reinvigorate their sector business. And I had, while at ETF.com, wrote a white paper comparing sectors to size and style, and sort of exploring why sectors as a framework are more impactful and more effective at breaking down the market than a style box. And as you can imagine, a firm that's heavily focused on sectors like Fidelity came across that research, and because of my network, I had gotten recommended to a couple people who were hiring there, and I moved to Fidelity in 2014 to help build their ETF capability from where they started, which was sector ETFs to active fixed income ETFs, factor ETFs, and the like. And then in 2019, late 2019, early 2020, I moved over to ALPS to help support their ETF business. So it's kind of this interesting intersection of your personal backstory and my familial background, and just this winding navigation of a road professionally that leads you to places where you might not think it will. And I've been very fortunate to be at the heart of one of the most important trends in my opinion in financial services, which is the ETF wrapper.
Well, I'd say you really kind of got in on the infancy too, even though ETFs were around before 2008, but coming out of the global financial crisis. And if you think about kind of how life happens and, you're just right place, right time to be with Claymore when you were going to school in Vancouver, which I'm sure was awesome. That's a great city.
Beautiful.
So I think it's a fascinating story and interesting background with how you arrived at where you're at now on the strategy side.
Yeah, and the point about right place, right time is so instructive for people in the industry and just in life in general. There's things you have control over, there's things you don't have control over. And I believe wholeheartedly that a lot of people who have risen to prominence in the ETF world, if you ask them or hooked them up to a lie detector test, they would admit that they were just fortunate to be in the right portion of a big firm at the right time as ETFs were starting to take off. And the reality is it all comes down to whether or not you capitalize on it.
Paul, one of the things that I find very interesting about that is if you were to tell that the same way without putting any years, like starting 2008, that plays out in my mind like it's 30, 40 years, the rise of ETFs, when in reality, we're in year 17 going on 18 of this massive boom into ETFs. It's just amazing to me how quickly it's been adopted and the growth has accelerated so rapidly. And, even the last couple of years, the way we continue to see assets accelerate out of other products into ETFs. For you personally, what was the most interesting part about moving from the writing, the moderation side, understanding the entire universe because you were seeing the entire playing field, to the strategy side for two individual firms that had their own focus on products?
Yeah, so there's an inherent naivety to being on the other side covering the ETF world. And what I mean by that is I remember distinctly I would write a piece because we would do blogs as well as the content we produced for the reports on our ETFs, as well as, of course, moderating panels at these conferences. And I remember distinctly I'd write a piece, like, for example, at the time, I don't know if you remember Paulson, not the Treasury Secretary Paulson, but the other Paulson, who famously was part of one of the most fantastic trades in Wall Street history, which was effectively shorting the housing market and all of the instruments associated with it. And around the time of 2011, 2012, he had a big hedge fund with all the money that he had accumulated on the back of that big trade. And he had sort of been in the media talking about how he was buying gold and he was making a big bet on gold. And you could see in his 13F filing that he was buying GLD. And I wrote an article at the time talking about how even billionaires can make a wrong trade. And I talked about how IAU at the time was cheaper on a headline expense ratio basis relative to GLD. And he was costing himself money in terms of the relative expense ratio. And a guy from State Street reached out to me and said, look, what you're not seeing here is that because of the creation unit size on GLD and the handle on GLD relative to IAU, the commission for actually trading in size in GLD for an investor like Paulson actually might be much cheaper and likely is much cheaper than trading a competing product with a lower expense ratio. And so in some ways, you get sort of so built up into being critical of what people are doing strategically or otherwise, and then you have your eyes open to some of the ignorance you have, not just around some of those product details that happen at other parts of the value chain for ETF investment, but also as it relates to product decision-making. What we're seeing right now in the ETF world clearly is a lot of legacy mutual fund managers coming to the ETF market with active strategies or building similar strategies to what they've offered in the mutual fund wrapper. We've seen, as you all know, a number of filings by key ETF issuers or mutual fund issuers to offer ETF share classes of a mutual fund or mutual fund share classes of an ETF. And the reality is that this is happening in 2025 as opposed to, say, 2009, partly because Vanguard had a patent on multi-share class, which only recently expired. But also, you have these strategic trade-offs within these companies where you have this legacy mutual fund complex that is profitable. And even if flows are going or even if you're experiencing outflows, maybe the fees and the revenue that those funds generate are still compelling from a business perspective, especially as the market is in the midst of a really compelling bull market. And so the idea of, well, why don't you just get into ETFs? Look at the chart of ETF flows versus mutual fund flows. How could you possibly be missing that? Isn't necessarily as easy once you actually get inside the walls of a firm that's trying to make those very difficult decisions from a profitability and strategic perspective around a legacy mutual fund business and the threat to quote unquote cannibalization of an ETF business. And so that was really eye-opening to me, especially going to a large firm who had a really large legacy mutual fund business and was struggling with a product development strategy as it related to what the implications might be for at the time, profitable mutual fund complex.
That's certainly the IAU GLD story is certainly fascinating when you think about total cost of ownership as opposed to, it's easy just to look at what an expense ratio is and think about it in those terms, but to think more broadly about the structure itself and how it's kind of functions.
Yeah, and we live in this Robin Hood world where you go on your phone and you click a button and you execute a trade. Well, 10, 15 years ago, that wasn't necessarily the world we operated in, and capital markets have evolved quite a bit over the course of the past 10, 15 years. But also within that, to your point, Jason, I think there is an institutional experience for trading in size in products, whether it's an ETF or individual securities, that the layman or the retail investor or even the smaller scale advisor might not be familiar with. So you have trade-offs and considerations at that scale that are just different than the trade-offs and scale for a typical investor.
That's any business too. If I'm going in, I'm starting my own outsourced fleet of black car service taxis to and from the airport. If I can go to a dealer and say, I'm buying 10 Escalades, 10 Tahoes, I might get a little shave off, the cost of each of those, or, apply that to any business where you're buying in bulk, you're going to get a discount.
Yeah. And I would just add, one of the eye-opening things about being on this side of the table, as it were, helping support the distribution and strategic efforts of an ETF firm is ultimately how difficult the day-to-day of an advisor is and how much it's evolved over the course of the past 15 years, going from simply that investment management function and ensuring that you're investing in the right things at the right times within the context of an asset allocation, and what my prior firm used to talk about, which is the advice value stack, which is now inclusive in that 1% or so fee that an advisor might charge a client, has things like financial planning, has estate and trust planning, has taxes, has so many different pieces of the overall landscape that the investment management piece hasn't necessarily been commoditized, because a lot of advisors do feel they truly differentiate themselves from other advisors through the effectiveness of their investment management strategies. But the reality is that it's just become more difficult to just focus on that piece of it because they're being asked to do so much more than just the investment management piece.
So I think in 2024, we saw 1.1 trillion in net flows into ETFs. So I'd really be curious to get your perspective on how the use of ETFs within advisor portfolios has morphed over the last 5 years, 10 years.
Yeah, it's a good question, because in some ways two things can be true at the same time. On the one hand, nothing has changed. People are still buying really cheap passive beta products in many of the key categories that fill out your typical asset allocation framework. But at the same time, things have changed. We've seen what feels like the advent of a new era for active ETFs. We had record flows for active ETFs in 2024, more than doubling the prior record. That, to me, is likely to be a durable trend, especially as we talked about with more of these legacy mutual fund managers potentially getting approval from the SEC to launch share classes of existing mutual funds. You're also seeing increasingly, I would say this is accelerated maybe over the past 2 or 3 years, the implementation of overlay strategies and option-oriented strategies, downside protection strategies that in the past might have been relegated to, if you want to call it that, annuity products or insurance products or even structured products making their way increasingly into the ETF wrapper. And so in some ways, the pie for all ETF flows that a ETF issuer can try and address is still very much dominated by those cheap passive products. I think that the statistic is still around 90 cents of every dollar in ETFs goes to cheap beta products or products with an expense ratio in the neighborhood of 10 bips or less. But because the pie is growing, and you talked about more than $1 trillion in inflows in 2024 alone, the slices of the pie are also getting bigger. So the addressable market for factor-based product, active products, downside protection products, thematic products, and the like is also growing. And so it creates an opportunity set for firms who are rethinking how the market is oriented from a beta perspective, meaning cap weighted in stocks, value weighted in fixed income, production weighted in commodities, and are able to not only exhibit durable, strong, relative outperformance in absolute terms, but importantly, as we often talk about, in risk adjusted terms. And I think that to me is what's so exciting about the coming decade plus of the ETF marketplace is that there was a period where it became a little bit sort of intimidating to go out and compete with the large or the big three as they once were because of their dominant place in the market. And those firms also, of course, have active strategies and factor-based strategies and offer them at fairly low costs. But the reality is that because the ETF market continues to grow at a rate that it's growing at and continues to take share from the mutual fund market, the opportunity set for ETF issuers who are doing really interesting things that are well designed, well articulated, and effective is also growing. And that's exciting for a firm like ALPS.
I would totally echo everything you just said there, Paul. One thing I want to hone in on specifically into more of the either active or factor-based approach, and it's an area I think that you have a ton of knowledge and familiarity with, is sector ETFs. What have you seen at the industry level that's changed about the usage and the implementation of sector ETFs now, the last couple years, versus what that may have looked like 5-10 years ago, similar to what Jason said?
Yeah, so I think the reality is that there's a lot of advisors and investors and allocators who were sort of brought up on the idea of the style box. You're large, you're mid, you're small, your growth, your value, your core. And they think about the market in that way. They look at the market through that lens. And the education process of getting them off of the style box and toward the GICS sector-oriented framework and sort of highlighting, if you will, the benefits of going to sectors versus size and style, the isolation of risk, the isolation of economic exposure, the consistency of the exposure you get at the sector level. I think we've made great progress in that over the course of the past 10 to 15 years. And remember, the Select Sector SPDR lineup was launched all the way back in 1998. So when we talk about the great financial crisis as sort of the moment of exit velocity for ETF assets, the fact is that the first ETF, SPY, launched in 1993. So there was a pretty decent seasoning period for what are fairly straightforward strategies, including sectors, which are also intuitive. When you think about sectors, oftentimes when I was at my prior firm or when I'm out engaging around the Select Sector SPDR lineup and we're talking to advisors or we're talking to clients and we're talking about the intuitiveness of the sector framework, one of the questions you talk about is, well, what is Exxon? It's an energy company. Everyone sort of knows that because that's typically where you go to fill up your car unless you have an EV. Well, if you have a Exxon style box ranking, most people probably don't know if it's a growth or value company at any moment in time, because that can also change dramatically. The amount of companies that switch between growth and value month to month is fairly dramatic over time, whereas the number of companies that switch between sectors is fairly subdued outside of outright reclassifications, like when real estate came out of financials or when the communication services sector was created as some blend of technology companies and old world telecommunications companies. So to get back to your question, Mackey, at a high level, I think people have gotten more comfortable with the sector framework and the benefits they provide. So in a market cycle like we're in, where there's concerns about risk and volatility, there's concerns about global exposure at a revenue level from some of the key sectors in the market, you can use sectors as a way to maybe dial down your international exposure. If you look at the breakdown in revenue among GIC sectors, sectors like utilities and REITs tend to have significantly less international exposure, as you would expect, than sectors like technology, which has the most foreign revenue exposure. So there's that piece of it. There's also the ability, at least historically, based on the relative risk profiles of various sectors, to turn down the dial on risk using sectors. And one of the products we often talk about, EQL, which just equally weights sectors, does it in sort of a one-stop fashion. You're taking technology, which is north of 32% by weight of the S&P 500, bringing it down to 9%. You're taking sectors like utilities, historically defensive, and bringing it up to 9%. So instead of having to go out, which some advisors do, and sort of pulling the lever individually on this sector or that sector, you can sort of do it in a sort of seamless way by adding EQL or a product like it to achieve that volatility or risk-oriented goal. So one of the ways I think sectors have evolved is less about trying to outperform the market, because even though the average spread between the best and worst performing sector over time is upwards of 50% in a given calendar year, I think a lot of people have come to realize that it's just really hard to pick which sector is the best performing sector in a given year. And bet sizing with sectors is really hard. When you think about overweighting a single stock, if you take a stock that's 2% of the S&P 500 and you overweight it by 10%, that's a meaningful relative weight. If you're taking a sector and overweighting it by, say, 2 or 3 or 4%, and then you're underweighting another sector as a result by 2 or 3 or 4%, that doesn't necessarily have a big impact on your overall portfolio. The attribution of that isn't necessarily going to be dramatic. So sector rotation, using sectors with the goal of improving returns, in some ways has given way to using sectors in a way to manage risk. And to me, that's a good outcome over time for advisors and allocators, because it speaks to the fact that people do often neglect the bottom of that risk reward equation when you think about the volatility of a portfolio, because they get so enamored with the return piece. And focusing on risk is an important dynamic. And even in talking to advisors about drawdowns with certain products, that tends to be a really important focus of sector-oriented investors that I've seen change pretty significantly over the course of the past 10 or 15 years.
Well, and that brings up a really good point when we think about sectors too. And obviously the Meg 7 have dominated headlines. I think one of the most overlooked details is, I believe it was 2018 when Apple became the first $1 trillion market cap company. And now we look at how many $1 trillion market cap companies there are. In fact, $3 trillion market cap companies. So that really is an interesting statistic that everyone kind of forgets what the market's been doing. But when you're looking at cap weighted, you're going to have some sector kind of on a historical basis, some sector overweights. So would EQL, do you think you could have a core position in EQL easier to think about from a risk standpoint, and then you can satellite around that for any tilts you want to build into the portfolio?
That is one approach we've seen advisors take, where they're using EQL as the anchor equity exposure within an asset allocation, and that sort of 60 portion of a 60-40 portfolio, and then maybe adding sectors up or down around it, or adding factors up or down around it. That's an approach we've seen. I think often advisors will also use it to augment a cap-weighted view of the market. So you have your cheap passive version of the S&P 500, and in moments like this where you're concerned about risk, maybe you're using EQL as a supplement to that to bring those sector weights maybe back to a more normalized level, or a more balanced level. Because again, to your point, Jason, about the emergence of $1 trillion companies and the concentration of those large companies in terms of their weight in the S&P 500, north of 30% in the largest companies in the S&P 500, that does or can wreak havoc on the sector profile and some of the exposures you have in the equity sleeve of your portfolio. And in the case of what we're experiencing here in 2025, when you have 30+% of your equity allocation in technology, in a market where technology has gone up, it's been rewarding an S&P investor. But in an environment where there's concerns about tariffs and the impact on foreign sources of revenue, as well as some destabilization in currency markets, then all of a sudden that foreign exposure tied to that sector, which is nearly a third of your equity allocation, can be problematic. And products like EQL, we've found, can be a compelling solution for investors and advisors who are looking to sort of manage through the risks of the market without having to necessarily overhaul everything that they've been doing. And certainly within the context of taxation too, understanding the taxable gain implications of wholesale moving away from a core position.
It's always amazing to get under the hood. And, one of the things we do here, in my role specifically, we partnered with Wide Charts to do a lot of analytics and get a really good look at advisors' portfolios, what they have. And I always love when I get, a portfolio that has SPY and QQQ, and then it has an XLK position. And you start to look really granularly at what the individual exposure of some of these names are. And it's like, was this a return chase that worked out really well at the risk of taking on some additional risk, and then finding solutions to navigate around that if there's a desire to trim, reallocate that risk budget. It's always great to take a peek. And I think, to your point, as we see more incorporation of sector type products, sector ETFs work their way into portfolios, it's going to help uncover other opportunities to reallocate that risk budget. So moving into the next area we wanted to focus on, factor investing. We've seen that sort of have its peaks and troughs as far as the attention it gets in the market over the last few years. But, we're starting to see some factors that may have been underloved, just underappreciated for a time, come back into favor. Things like high quality, things like just pure value. What are we seeing as far as attention goes around some of these factors and factor investing in general? And what role are you seeing these factors play in portfolio construction now in 2025?
Yeah, the factor conversation is really interesting because just going back in history to when I was at ETF.com and Index Universe, it was sort of coined as smart beta, and then it evolved into strategic beta and has gotten more simplified in terms of factor investing. And in many ways, it's another evolution of investment management and of financial services, just like ETFs are, right? ETFs at their core are another investment technology that in many ways has unlocked a lot of value for individual investors through the tax efficiency and the cost savings. All else equal, ETFs tend to have lower fees than their mutual fund counterparts and tend to be more tax efficient. So that evolution, that technological advancement of the ETF being introduced in 1993 and continuing to grow and continuing to evolve has now been met over the course of the past 10 to 15 years by an additional advancement in terms of index technology and the ability to parse out and attribute the drivers of return for a portfolio. And everyone has different approaches to defining factors, but at a high level, you're just trying to peel apart what drives the market's returns in different periods of time. And to your point about quality and or value, different factors tend to have their own day in the sun depending on the market backdrop. In the current market context, we've seen that momentum factor, which was the best performing factor in 2024, has been, if not the worst, one of the worst performing factors here in 2025. And yet, if you go back over the course of this multi-year bull market coming out of that 2022 correction, quality has actually been at or near the top of the league table from a factor performance perspective. And so if you were to just think about all of those factors, whether it's value, whether it's growth, whether it's momentum, whether it's quality over long periods of time, quality in many ways is just a way to define what a GARP manager or a typical active manager might have done once upon a time, but because of the efficiency of markets and technological advancements, you can now run a rules-based version of what an active manager might have been paid highly to do with a team of analysts looking at satellite photos of parking lots. And in many ways, it allows investors to still align with this overall depression in the cost of accessing the market. In other words, declining fees for investments over time, while at the same time tapping into some of those durable components of market return that tend to be pretty durable over time. And for quality, our steadfast belief is that quality is, if not the most important, one of the most important factors from an investment perspective within the equity landscape, increasingly so as you get further and further down the cap spectrum. And so when you think about value versus growth or value versus momentum, I like in some ways to just pull quality out of that conversation because it doesn't necessarily fit as cleanly in the way that some people perceive the factor framework, meaning you're thinking about companies that either have high ROE or high ROA or high ROIC, depending on how it's been defined. Maybe you have some balance sheet metrics like net debt to EBITDA, as we do with the O-Shares products here at ALPS. But importantly, all you're really trying to do is take the market portfolio that you're addressing, whether it's large caps, mid caps, international, or otherwise, and just cull it down to companies who have characteristics that an active manager might have seeked out in the past, but might have charged you significantly more fees to get access to.
Right. And you know, we've seen you before talking about Russell 2000, 40% of the companies are not profitable. So that's in the small cap space in particular. But what I find really peculiar about quality is if you ask any individual investor who's buying stocks, kind of the framework for what they look for in companies that they buy, they really tick off a lot of the quality metrics. Whether they're actually doing that or not is a different story. Sometimes they want to, you know, the hot item of the day. But when you ask them how they think about investing and what they want to buy, it really comes down to quality metrics, attractive balance sheets, low debt.
Yeah. And if you have CNBC on in the background in an office setting, or you're at the airport or something and it's on the TV, you might see an active manager or an advisor come on the TV and say, we want to buy companies with great free cash flow, strong profitability, strong earnings growth, stable balance sheets, and ultimately they're just articulating the nuances of a quality factor strategy. And so removing the human element from the portion of investment management that often aligns with an active strategy can, over time, be something advisors and investors are interested in, because ultimately there is no discretion over a rules-based systematic strategy like, say, OUSM or OUSA. It is simply the factor methodology that drives the rebalance, that drives the reconstitution. And nobody's ever going to fall in love with a stock in a portfolio and believe that they're right, even if the market is telling them they're wrong, because the rules are the rules. And that type of sort of unemotional approach to factors is part of the reason I think this segment of the market has become so popular. And we've seen these various complexes grow so much.
I look at quality as, if somebody asks me, you get to be CEO of a company, but you also have to get 8 hours of good sleep every night, I'm listing off all the things we've listed as a high quality company to be the CEO of.
Yeah, that's an interesting way to put it. I've never really thought about it like that. I've never been a CEO, probably will never be a CEO, certainly not of a large company. But the reality is that when you buy a company, an individual stock or a basket of stocks, you really want them to generate profits, or at the very least, if you're thinking about it through a growth framework, you want them to get to a place or have the potential to generate meaningful profitability eventually. If you go to sort of the basic academic definitions of valuation, you're either using a discounted free cash flow model, which is sort of the most popular framework for valuing companies. Well, in order to have free cash flow, in theory, you have to have revenues, and maybe you have to have accounting earnings, maybe not, depending on the nature of your business, but you also need to have the potential to generate those things. You also might use something like a dividend discount model where you're just looking at how that company's dividend looks and what the expectation is for growth on that dividend. And then you're getting to a stock valuation based on that. Well, in the case of a quality framework, often you're not necessarily looking at the dividend side because you're just focused on the fundamental characteristics, the return on equity, the return on assets, the return on invested capital, or you're looking at leverage metrics. Well, in the case of the O-Share suite, what's unique about it in the factor landscape is that you're pairing the dividend component, looking for dividend growers, looking for strong dividend coverage, and you're marrying that with the fundamental quality characteristics. And that, in many ways, to your point, Mackey, is how a lot of people probably would invest if given the capital to do it on their own, assuming, of course, that they've got experience and some familiarity with how companies are valued and how companies operate.
So earlier we were talking about sectors before we dove into factors. So I'm just curious when we think about, certainly factors that are included in the ALPS lineup and broader factors in general, kind of how does that impact the sector weightings of the funds? Is there some tilts that come about by certain factors?
Yeah, so one of the factors we didn't talk about was low volatility, which I missed when I was listing off the various factors that people use. And oftentimes, when you look at a low vol factor strategy, it's often sort of a sector strategy in disguise because it ends up having a lot of UTs, a lot of healthcare, a lot of staples in the portfolio.
All defensive sectors.
Naturally, those companies have been lower volatility than their growth-oriented counterparts or their momentum-oriented counterparts. And so what you have to be careful of, and what some issuers and index providers I feel have done a good job of, is introducing guardrails around sectors so that when you're trying to extract a given factor, whether it's volatility, whether it's quality, whether it's momentum or otherwise, that you're not running too far afield of the market sector weighting. Because in theory, if you have a portfolio that goes from being the market's sector profile, say the S&P 500, to a portfolio that's 95% in 3 sectors, logically, I would think an advisor might say, well, why don't I just buy those sectors as opposed to buying your factor-oriented product? So I think low vol is the one that sticks out the most in terms of the sector implications of taking a factor-based approach. And in terms of quality, if you look at some quality strategies pulled from large caps, it tends to differ quite substantially from a quality framework in, say, a small and mid cap approach. For example, OUSM versus OUSA. If you look at the strategy in the small and mid cap space, which is screening for high ROA, low net debt to EBITDA, dividend growth, and dividend coverage, you end up having similar financial services exposure, for example, to the Russell 2000. But the makeup at the industry level within that sector is very different than the market portfolio in this case, as defined by the Russell 2000. So you get both, right? I think in some ways you get sector deviations that can be material in some of these factor-based products. But importantly, you also get industry level deviations that can be instructive in terms of how that methodology translates or manifests in terms of the exposures that you have at the individual stock level. And that, going from GICS sector level to GICS industry level to GICS sub-industry level, can also be an important consideration as people think through a factor framework.
When you're looking now at the advisor toolbox and the role that factors have come to play in that toolbox, are you seeing more of these as a strategic ballast type position or more of a tactical satellite, or does it depend on the actual factor and what the advisor is looking for?
Yeah, I think it depends on the advisor and certainly the market backdrop. I mean, as I said earlier, we feel strongly that quality as a factor framework is a way to build a durable equity exposure in a strategic way, not necessarily in a tactical way. You see momentum strategies maybe used in a more tactical way because the momentum factor tends to be at least a little bit more dynamic than other factors, like even low vol. In fact, if you look at momentum strategies over time, they might end up looking very similar at the sector level to a low volatility strategy when those lower volatility sectors and companies are outperforming. The problem, of course, is that at times what you can see is that the momentum factor is sort of slow to catch up to that volatility factor, meaning by the time they're adding those lower volatility sectors and companies as a result of them showing up on a momentum screen, it might be too late in the cycle on a relative basis for those companies to contribute meaningful relative outperformance. And so I think that's why we believe a quality framework is a compelling core anchor strategic allocation in the equity sleeve of a portfolio, because again, getting back to what we talked about, you're talking about the characteristics that a typical investor might be looking for, screening for, or talking about when they're trying to allocate to equities anyways. And so doing so in a rules-based systematic manner that rebalances and reconstitutes over time, we feel is a really compelling ballast to use your language, Mackey, for advisors.
We're only a month into Q2, and it feels like we've had 2 different years this early in the. You think back to even in Q1, I think we saw a rotation happening where value was looking more attractive before all the tariff noise that came about at the beginning of April. What are you seeing with respect to the ALPS lineup as far as your engagements and where you're seeing the most interest?
Yeah, so I would say the other thing that's taken place so far in 2025 is maybe a head fake, maybe not, but we've seen this 16-year or so period of U.S. exceptionalism, relative outperformance of U.S. equity markets compared to either EFA or EM, and it's flipped a little bit so far in 2025. In the early part of the year, we've seen outperformance of EFA, of Europe, relative to the United States. And so thinking through how investors have been allocating, how advisors have been allocating through this 16-year period of U.S. outperformance or U.S. dominance, we've seen a number of advisors who have either thrown their hands up on developed ex-U.S. strategies or sort of abandoned any ex-U.S. allocations altogether. And certainly if you think about a risk-reward framework and creating durable, diversified portfolios over time, the sort of typical framework that most people use to build those asset allocations would tell you that developed ex-US, EM, and anything ex-US is a diversifier. But because it's continued to underperform and been a sore thumb in client portfolios, people have sort of abandoned it or gone down from the proposed weighting or neutral weighting to an underweight position. And we're starting to see people finally, whether it's home office research people, whether it's model portfolio providers or individual advisors, start to get back toward neutral or even above neutral in terms of their relative weighting to international markets, whether it's developed ex-US or EM. And so in that way, we've been engaging a lot around IDOG, our international dogs of the Dow strategy. We've also seen investors who are just trying to manage drawdown risk in this context. And to the extent that a strategy like OUSA in the large cap space or OUSM in the small and mid cap space can exhibit shallower drawdowns over time, advisors have been really engaging with the story around how that portfolio is designed and what that translates to in terms of relative risk and relative drawdown risk. And that to me is one of the things that's stuck out so far in 2025 is advisors being concerned about the economic backdrop or the economic outlook. We're seeing the R word pop back up in financial research and financial media. It's sometimes politically motivated, other times not. And anytime that R word pops up, or God forbid the stagflation word pops up, advisors are naturally looking for ways to just turn down the dial on risk. It's why we've been talking about EQL. It's why we talk about OUSA and OUSM, because those products have historically exhibited less volatility. And I would imagine there's advisors out there who are also looking at things like the low volatility factor as well.
Sticking with advisor engagement, advisor behavior, I always sympathize with advisors because they have such an important role for their clients. It's one part managing the money, but also the psychologist aspect and hand-holding and guiding their clients through all these different parts of life. And their role gets compounded, call it 1,000 times when we hit these turbulent periods where their job becomes to pass along information to their clients and make sure that they can get through these situations, mentally, emotionally, and financially okay on the other side. In your career, what have you noticed the most about the way advisors handle these situations, the best way to engage with them, especially as we've seen ETFs play a different role in the market in their portfolios over time?
Yeah, so I'm glad you brought up this psychology point, because I do think it is increasingly critical to the advisor business model. Because if you go through the CFA charter and the various levels of exams, there's ethics, there's of course quantitative and statistical analysis that you have to do, but there's also a behavioral finance aspect to level 3 that I always found as I was going through it really important and really interesting, because there is a human element to money. Money is a very personal thing, and investors who are in the market through an advisory relationship or otherwise have these fallacies, logical fallacies, as well as behavioral challenges that they struggle to overcome on their own. And so to your point, Mackey, I do think advisors have been now asked to be both investment counselor and personal counselor as it relates to managing through client portfolios and various market cycles. And I do think advisors have gotten better at it over time, because they've got a better handle on the behavioral aspect of the investment relationship. And importantly, there's been some really compelling research done on the importance of behavioral finance as it relates to the advisory business. And to me, that's a good outcome, because saving investors from sort of their being their own worst enemy at the worst possible time in market cycles, knowing that declines cluster and advances cluster, and the importance of not missing out on those meaningful advances in the market is really important to the sort of the fundamental concepts of investing, which is at its core compounding your wealth over time. And if you do things that are antithetical to rational investment behavior, it can undermine the power of compounding over time and undermined your objectives financially.
It's that old, I hate to be cliche, but it's time in market, not timing the market. And as you said, Paul, as advisors have gotten better with the behavioral side, that's ends up being one of the core messages. No matter how it's relayed, it is one of the core messages that gets home. Looking and pivoting a little bit to the financial side, what's one or two pieces of advice you would give to any advisor when they're setting up their review period or looking to make ETF selections? What would you pass along after all the experience you've had in this industry?
Yeah, so one of the things, and it's, to borrow another cliche from Peter Lynch, one of the most famous investors in Wall Street history, know what you own and why you own it. That's true for individual investors buying stocks. It's also true for advisors. Know exactly what the product is designed to do, and then know whether or not it's actually doing those things. It's great to see this methodology paper and see all of these complicated formulas on a piece of paper in an index methodology or in a product document, but does that actually translate to what it's supposed to translate to? In the case of OUSM, what we often talk to advisors about is, look, this product is called a quality dividend strategy. Well, if you look at its relative profitability profile to its benchmark, either the Russell 2000 or Russell 2000 value, it does typically have a significantly higher profitability level. Does it have a dividend profile that's distinct from the market? These companies do tend to grow their dividends more, and those dividends do tend to be well supported by fundamentals. And if you look at the drawdown profile or the relative risk profile of the O-Share suite relative to their benchmarks, they do tend to exhibit lower drawdowns and less volatility over time. So know exactly what you own and why you own it, but also understand that although we've seen, as we talked about at the top of the podcast, a significant amount of durable flows into cheap passive beta products in key categories of an asset allocation framework, understand that there are pockets of the market where outperformance, both absolute and risk adjusted, is possible. The SPIVA report is sort of the gospel and the Bible for all things passive. But the reality is there are a number of categories, whether it's real estate, whether it's fixed income, where active managers have been able to generate strong relative outperformance. And in many cases, not just in absolute terms, but in risk adjusted terms. And so don't necessarily be wed to the idea that all you have to do in every category is find the cheapest possible product to get you the exposure that you're looking for. Be a little bit open-minded in terms of what may drive returns and risk over long periods of time, and focus on that risk metric, because that often gets lost in the shuffle of a market environment where we've been in effectively a 15-year bull market with a couple short bears in between.
So I think that's a great way for us to end this part of the content for today. But I also want to get into a little bit of a game that I suspect is going to be challenging for you, Paul, and that is rapid fire questions.
Love it. Yeah, I'm not very rapid, am I?
So maybe we limit it to 1 or 2 word answers.
Okay.
But I think this will be fun, especially since we covered kind of your journey into the industry, sectors, into factors. So what is your favorite ETF ticker that you've come across?
Ooh, I've always been a fan of Hack, just as a cybersecurity ETF. I always thought that was a clever ETF name. We just launched an electrification ETF. ELFI is the ticker. I really like that as well. So, call me a homer if you will, but those are tickers that pop out to me.
Most misunderstood ETF concept.
I think it's important in this moment, the daily reset of leveraged and inverse ETFs, because they've been increasingly popular with retail investors. And that daily reset is really critical to what your return path looks like over time. These portfolios typically reset daily. And if you're not in them for just a day, then your return path can differ greatly from what your expectations may be. You're not going to get 3 times or 3 times inverse over long periods of time. And that can surprise investors who aren't familiar with the structure and the decay that comes with investing in those portfolios.
I really thought you were going to say liquidity there.
Look, there's been 1,000 papers on the difference between liquidity and volume on ETFs. We have our own piece that we try to use to help support the distribution of some of our smaller properties at ALPS. But I think there's been great progress in terms of education around the difference between on-screen activity and liquidity. So I was trying to go off the beaten path a little bit there, Jason.
All right, I appreciate that. So then now let's get into the real meat. Giants or 49ers? Which of your Bay Area teams has a better shot this year?
49ers, without a doubt. Franchise, elite quarterback, best linebacker in the business, one of the best edge rushers, best left tackle in football, best running back in football, best tight end in football. For me, that's a good way to start any team.
It's a lot of money tied up at the tight end position.
As the best in the business. Yeah, best in the business.
He is awesome. He's so fun to watch. He's
easy
to root
a
for
tight
too.
End.
Yeah.
He's actually a tight end.
No doubt.
I will say, I think you got some great value in the 7th round pick this year in Montana native Junior Bergen from my alma mater, the University of Montana.
One of the best punt returners in the history of college football, as I understand it.
Absolutely. You've probably been reading all the chat groups. They're like, who's this guy from Montana?
Yeah.
I think that's a bargain in the 7th round.
I love it.
Go to ballpark snack. You're going to a game. What are you grabbing?
At Oracle Park in San Francisco, the most beautiful ballpark in the world, I would say people mostly say garlic fries, which is not necessarily my cup of tea. They have a crab melt sandwich out in the bleachers behind center field. That's incredible.
It sounds good. I'll have 4 of those.
Yeah.
You, like many of us here at Rock Harbor, golf degenerate. Favorite golf course you've ever played?
Yeah, I haven't been as fortunate as Sean to play most of the top 100 courses in the world and or the country, but there's a course down near Santa Cruz. Pasatiempo is recently featured on TV because they had the intercollegiate out there, and that is an Alistair McKenzie course that's a hidden gem out there. Most people go out there, they go to Harding or they go to Olympic Club if they have a hookup, or maybe they even go down to Pebble, but Pasatiempo is one of the most beautiful pieces of property you'll ever see and one of the most well-designed courses you'll ever play.
I'm going to have to add that to the list.
And they have burger dogs, which is something most people have never had or experienced, which is just incredible.
I like the idea. Easier to eat, probably less of a mess.
Yeah.
I guess we could make them at home too.
Yeah.
So same question, but we're looking for a different answer. If you had one round of golf to play for the rest of your life, you can only play one course one more time, what would that course be?
Probably Sheep Ranch up at Bandon.
That's a good one. Who are you taking with you? Who's rounding out your foursome?
Probably my best friends from middle school and high school and college, and they're all just as hooked on golf as I am, and they all love beautiful places of the world. So that would be my ideal foursome. Now, if we're talking about ideal foursomes, I would probably go Jerry Rice, Michael Jordan, and Steph Curry.
You think Steph's taking home the bacon for low score that day? He's a stick.
Yeah, but Michael Jordan is an absolute psychopath, and so I just wonder if he'd be able to get over the mental hurdle of getting trash talked for 18 holes by the best to ever do it.
I like that.
That would make it a challenge, certainly.
Yeah.
Well, Paul, thank you very much for joining us. I think this was a great conversation. Listening to your kind of comeuppance into the industry, I know I had a similar story. I started running my own Roth IRA when I was a young teenager. So with every money I made, I'd have to put it in this Roth. I'm like, why can't I keep the money? And so when I invested it, it was all in small cap value, and that worked out really well. So I have an affinity for small cap.
While you're still working, you should be retired by now if you start investing then, based on the power of compounding, my friend.
Well, obviously, some poor decisions were made along the way, Paul. Golf and life and everything else got in all the expensive habits. If I was still living with mom and dad, I would be.
Yeah, there you go. I love it. Well, thank you, guys. I really enjoyed this. This was fun.
Awesome having you, Paul. Always great to catch up with you. We certainly appreciate everything from a knowledge and experience standpoint that you bring. Hopefully, there's a ton of value for everyone that tunes in.
Awesome. Thanks, guys.
Thank you. Have a good one. That's a wrap on today's episode. Big thanks to Paul Baiocchi for joining us and sharing his insights on sector strategy, factor investing, and how advisors can cut through the noise in today's ETF landscape.
If you're an advisor thinking about how to better position your portfolios heading into the second half of this year, whether it's quality, deep value, or a more specific sector approach, we certainly hope you had some great takeaways from today's episode.
Make sure you subscribe to In the Harbor, wherever you get your podcasts, be it Spotify, Apple, you name it, so you don't miss out on upcoming episodes with more market voices and advisor insights.
And if you'd like to follow Paul's work, you can find him on LinkedIn and check out the latest ETF commentary from SS&C ALPS Advisors and Select Sector SPDRs online. Worth keeping on your radar for sure.
Thanks again for listening, and we'll see you next time in the harbor.